Good afternoon, everybody. This is John Rhoda at Riverbend Investment Management. Welcome to our Big Picture Weekly Market Update. This is for the week of August 25th, 2022. So to start off today, I want to talk a little bit about what's been going on in the bond market for the last couple of weeks. What we've seen is, first off, to talk about this chart here. This is the 10-year, 2-year Treasury spread. And what it basically is the 10-year rate minus the 2-year rate. And when you see a red line here below our zero dotted line here, it's an indication that that relationship has reversed. That's basically inverted, meaning that if you would go out and buy a 2-year Treasury bond right now, you would actually get a higher interest rate than you would for a 10-year Treasury bond. And that's a little backwards than what normally happens. Normally, you would be rewarded for locking your money up for a longer period of time with a higher interest rate. So you'd expect that if you're going to lock up your money for 10 years, you would get a higher interest rate than you would for a 2-year bond. But the exact opposite of that is happening right now. Now, I bring this up because this type of indication where we have this inverse relationship has been a very, very good gauge historically of predicting future recessions here in the US. And what we can see here is really this relationship and how it pans out eventually into a recession. However, it doesn't mean that we're in a recession right now, and it doesn't mean that a recession is possibly a month or two away. This relationship can take quite some time. And as you can see here, for example, this is the 2008, the Great Financial Crisis. We really started getting early indications in the bond market that they were worried about really the growth in the economy and what was going on. The economy was starting to get overheated, and we started to see this inverse relation starting to form back in early 2006. Well, it wasn't until January 2008 that the people that label recessions labeled it as the start of the recession back then. So you can see here it can take months, even possibly years, for recessions to start to unfold. Now, I bring this all up because what's been going on in the market for the last couple of weeks is we've seen basically a reversal of this rise in interest rates for the last couple of weeks, and we've actually seen interest rates come back down a little bit, and that's helped fuel stock prices a little bit, especially in some of the growth and tech names. The reason for that is that a lot of investors, and we're discussing that this idea of inflation might be right around the corner. It might be sometime in 2023, and that would mean that the Fed would need to stop raising rates and potentially start to lower rates again, because that's how they combat a recession. They start to lower rates to help stimulate growth in the economy. Now, the problem has been that the economic data that's been coming out for the last couple of weeks has been, I think, a little stronger than what people expected. It's still showing that we're in a fairly strong economy right now. And that's going to have an impact in twofold. One is that the recession is obviously not right around the corner. So that gives the Fed a little bit more wiggle room to be aggressive with interest rate hikes. And it's also a potential driver of inflation, because if we still have strong demand for items that have been causing this inflationary increase, if that's still present, it's still going to cause inflation. So I think the market's starting to worry again that maybe inflation is going to start being an issue a little bit longer than they had expected previously. We can see this starting to be reflected in the bond market. These are fixed income, these are bond ETFs, and you can see here the bond prices are starting to fall. And if you remember, bond prices and interest rates have an inverse relationship. So as bond prices fall, interest rates rise. And that's what we're starting to see the beginning of. We're starting to see sell signals across the board, short-term and both long-term in the bond market. If we look at the AGG ETF, which represents basically the broad bond market, we can see exactly what's been happening this year. We had this steep decline in prices as interest rates rose, and then we were really fairly oversold within the bond market, and we started to see prices start to rise. And then we hit a bit of an inflection point here, and the market started to reverse back down. Now we're seeing sell signals, we're seeing weakening momentum across the board in the various areas of the bond market. This is starting to have an impact on stock prices. Last week, I brought this chart up and I showed that we are basically in a inflection point here as we hit our 200-day moving average, which is this orange line here, and this downtrend line in the market. And we are fairly overbought in the market, starting to see a bit of weakening in momentum, and really this fall off in volume, indicating that this participation in the market was starting to get weaker and weaker, and less people were participating in the market. And fast forward to now is we saw that reversal occur. We saw basically the market hit exactly to that point and reverse back down. We had our sell signal and our stochastics. We're starting to see sell signals in our longer term momentum indicators, indicating that the market looks like it wants to pull back a little bit further. Now, this red area here, this is an area of support short term in the market. And we've been sitting here for the last couple of days, in part because the market is waiting to see what Fed Chair Powell says tomorrow at the Jackson Hole meeting. Jackson Hole meeting is a gathering of basically major business leaders, and he's going to be speaking tomorrow morning. And we want to see if he says anything unusual or unexpected before really moving on it to see which way the market reacts to it. And I think that's what a lot of investors have been doing this week. They've been just kind of holding on, not really committing in one way or the other, because they want to see what Chairman Powell says tomorrow about what they're seeing inflation-wise and what they're seeing about interest rates and how that's going to impact the economy going forward. If we take a broader picture or a kind of a bigger picture, we look at our weekly charts, and this really helps show where that overall trend is in the market long term. And as you can see here, we're starting to see a sell signal on those weekly charts, indicating that longer term momentum is starting to shift negative again. And the reason charts like this are important is that larger institutions like mutual funds, for example, they control billions, if not trillions of dollars. So when they start to exit the market or enter the market, it can take them days, if not weeks, because they are buying or selling millions and millions of shares, which they obviously can't do in a very short period of time, or they run into liquidity issues. So it can take them a fairly long period of time to adjust their portfolios to be basically looking for growth or looking into more defensive names and possibly selling off to protect as much of the portfolio as they're allowed to. But basically, when we see these longer term trends, we like to pay attention to them because, it's an indication that some of those slower moving, larger funds that control a huge amount of money are still not aggressively buying into this market yet. So this is, again, another indication that the market is starting to weaken again. If we look at individual stocks, this is Apple, and Apple is the largest stock by weight within the S&P 500. So it's important to look at these stocks that have a heavy weighting on the S&P 500 because it gives us an indication of what's going on under the hood. And we can see here the same thing. We hit this trend line. We started to reverse back down. We're seeing sell signals and momentum and sell signals from overbought levels. So again, we're just paying attention to what's going on in the market here. And it seems like the market is not willing to go higher at this point. They're not willing to commit significant levels of capital at this point. So we can see that reflected in our market trends. You can see here just this investable universe. Really across the board, we have sell signals, momentum sell signals, long-term signals starting to go negative. So again, just not a great picture if you're invested long in this market right now. Sector trends, really a lot of just negative sell signals, not just continued weakness in here, with the exception of energy. And energy, if you remember, gas prices were starting to go up because of the demand, because of what was going on in Ukraine, and just because of inflation. And then for the last couple of weeks, prices have pulled back a bit at the pump, in part due to, I think, the economy, in part due to a lot of investors and traders thinking that, okay, if there's a recession on the horizon, that means people are going to need less gas because there's going to be less product shipped, less people driving. You just a less smaller demand for fuel and oil. And now that idea that recession might be pushed back a little bit further, possibly into 2024, and we're still in a fairly strong economy, well, that traders start to look at that and think, okay, this demand for fuel and oil is still strong, and they're starting to re-enter the market potentially looking for higher fuel prices and higher oil prices. And we're seeing that reflected here in the energy sector as the energy sector is starting to rise again. This is all the broad sectors within the S&P 500. And this is just a dashboard chart that I keep up on one of my screens all the time. And what this shows is basically the weekly charts versus the 40 period moving average, the 40-week moving average, which basically is a replication of the 200-day moving average. And what we can see here is in the defensive names like energy, for example, we saw a pullback in price to that moving average, and it's starting to rise again. Consumer staples are starting to break above that average again. But let's look at the growth stocks. Technology, what happened? It hit that trend, that moving average, and pulled back. Healthcare is having trouble getting above that. Financials are starting to pull back. Consumer discretionary pulling back. So we're seeing really across the board, we're seeing this pullback on the growth side of the market from these levels, and a resumption of that previous trend we saw where energy stocks and defensive nature stocks were starting to lead the market. And it seems like we're starting to get back into that type of cycle again. And finally, taking a look at just sector rotation charts, just to show you what kind of what it looks like. If you remember, these charts tend to rotate in a clockwise fashion, and basically the high, if you're pointing up into this upward right direction here, it's an indication that the market's getting stronger and stronger in that particular area. And what we're seeing, energy get stronger, consumer staples get stronger, and weakness in the growth names like technology and consumer discretionary. So that's really where we are in the market right now. Like I said, we're going to be listening closely to what Chairman Powell says tomorrow at the Jackson Hole meeting to see if he says anything unusual or unexpected about inflation or about interest rates that could potentially drive the market significantly higher or lower and add an extra level of volatility to the market, or if he's just going to kind of stick with the same counterpoint, the same statement that he's been saying for the last couple of weeks, that they expect that inflation is going to start to get under control at some point. So we're going to keep a close eye on that and really see what they say tomorrow. So that's it for this week. Next week, we'll talk a little bit more about Chairman Powell's, what he says and the impact that it's having on the market. If you have any questions, please feel free to reach out to me. Best way is by email at john.rhoda@riverbendinvestments.com. If you're on Twitter, you can check me out at John Rhoda, where I post more daily charts and more. If you want to get a little bit more in depth, you can look at some of the charts I post there. So that's it for this week. Thanks, everybody, and we'll chat back again next week. Bye-bye for now.